Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of Mastering Candlestick Patterns, a complete guide for traders in 2025. Traders rely on patterns to make sense of market movements, and candlestick patterns are among the most trusted tools. These visual charts don't just show price data, they reveal trends, emotions, and potential shifts in the market. Whether you're a beginner or an experienced trader, understanding these patterns can sharpen your decision-making and boost confidence in your trades. History and origin of candlestick charts. Candlestick charts are more than just a tool for traders, they're a window into market psychology. These charts tell stories about price movements with simplicity and elegance, but how did they come to be? To understand their importance today, let's take a step back and explore their fascinating origins. The birth of candlestick charts in Japan. Candlestick charts trace their roots back to 18th century Japan. They were developed by Munehisa Homa, a rice trader from Sakata. Homa was more than a successful businessman, he was also a visionary. He realized that emotions like fear and greed played a huge role in the pricing of rice. By observing patterns in price behavior, he created a method to visualize these shifts. Homa's system wasn't just about numbers, it included human behavior. He combined price action with sentiment, resulting in a charting technique that's as much about psychology as it is about data. His work laid the foundation for what we now call candlestick charts. Back then, these tools were revolutionary. Rice markets in Japan were incredibly competitive, and Homa's approach gave him a significant edge. His insights were so effective that he wrote several books on market psychology, some of which still influence trading strategies today. How candlestick charts reached the West. For over a century, candlestick charts remained a closely guarded Japanese tool. It wasn't until the 1980s that they gained global recognition. Steve Nissen, an American technical analyst, is credited with introducing candlestick charts to Western financial markets. Nissen learned about this method while studying Japanese trading practices. Recognizing its potential, he began teaching it to traders worldwide. Through his books and seminars, candlestick charts became a staple in technical analysis. They weren't just embraced, they were celebrated for their simplicity and depth. Why the rapid adoption? Western traders quickly noticed the clarity offered by these visual charts. Unlike bar charts or line graphs, candlesticks provided more information with a single glance. They didn't just show the high, low, open, and close prices, they revealed patterns, trends, and even potential reversals in ways that other charts couldn't. The evolution into modern financial markets. Today, candlestick charts are everywhere, from stock markets to cryptocurrencies. Digital trading platforms and advanced charting tools have made them easier than ever to use. Despite their origin in rice trading, their application spans industries and asset classes. Modern traders use candlestick patterns like the Doji, hammer, and engulfing to predict market movements. These patterns have been studied, categorized, and backtested across decades. While new tools have emerged, candlestick charts remain one of the most trusted methods for analyzing markets. What's fascinating is how little they've changed over time. The core idea, capturing price action and emotion in visual form, has stayed the same. This consistency speaks volumes about their effectiveness. Basics of candlestick patterns. Candlestick patterns are the backbone of technical analysis, offering traders a quick way to digest market information. They combine price movement with a visual format that's easy to interpret. By understanding how to read these patterns, traders can identify trends and make better decisions. Let's break down the basics. Anatomy of a candlestick. Each candlestick tells a story about the market's price action during a specific time period. To interpret that story, you need to understand its three main elements. The body. This is the thick rectangular part of the candlestick and represents the difference between the opening and closing prices. A long body shows strong buying or selling pressure. A short body indicates indecision or minimal price movement. The wick, or shadow. These are the thin lines extending above and below the body. The upper wick shows the highest price reached during the time frame. The lower wick shows the lowest price. Colors, or fill, candlesticks are often color-coded to make reading them easier. A green, or white, candlestick means the closing price was higher than the opening price, bullish. A red, or black, candlestick indicates the closing price was lower than the opening price, bearish. Think of the candlestick as a snapshot of the battle between buyers and sellers. The body reveals who's winning, while the wicks show the highs and lows of that fight. Bullish versus bearish candlesticks. Candlesticks aren't just random visuals, they're tools to help you gauge market sentiment. To trade effectively, you need to know the difference between bullish and bearish candlesticks. Bullish candlesticks. A bullish candlestick occurs when the closing price is higher than the opening price, signaling that buyers dominated the market. Example. Imagine a green candlestick with a small lower wick and a long body. This shows prices opened low but climbed steadily as buyers pushed the market upward. Bearish candlesticks. A bearish candlestick forms when the closing price is lower than the opening price, indicating sellers had control. Example. Picture a red candlestick with a long upper wick and a small body. This reveals prices tried to rise but were pushed back down by selling pressure. Understanding these two types of candlesticks is crucial. Together, they create patterns that hint at what might happen next in the market. Each candlestick becomes a clue, helping traders decode the next possible move. Common single candlestick patterns. Single candlestick patterns are crucial for traders aiming to spot potential market reversals or continuations. These patterns are straightforward yet impactful, providing actionable insights into market sentiment during a specific time frame. Let's explore some of the most recognized single candlestick patterns and how they can guide your trading strategy. Doji. The Doji candlestick is one of the simplest yet most significant patterns in technical analysis. It forms when the open and close prices are nearly identical, resulting in a very small or non-existent body. This pattern signals indecision in the market. Neither buyers nor sellers dominate. There are several Doji variations, each carrying its unique implications. Long-legged Doji. This variation has long wicks on both sides of the body, indicating significant price movement before settling near the open. It reflects strong uncertainty, often hinting at a possible reversal when emerging after a strong trend. Dragonfly Doji. This Doji has a long lower wick but no upper wick, meaning the price fell significantly during the session but recovered to close near the open. It often signals a potential bullish reversal, especially in a downtrend. Gravestone Doji. The opposite of the dragonfly, this Doji features a long upper wick and no lower wick. It suggests that buyers initially pushed prices higher, but sellers regained control, often hinting at a bearish reversal. When you spot a Doji, pay attention to the broader context. Its meaning becomes more impactful when paired with trend strength or nearby support, resistance levels. Hammer and Hanging Man. The hammer and hanging man are visually identical but have opposite meanings depending on their location within a trend. Both feature a small body near the top of the candle with a long lower wick, resembling a hammer. Hammer. Found during a downtrend, the hammer signals that sellers initially drove prices lower, but buyers stepped in, leading to a close near the opening. This shift suggests a growing bullish sentiment and the potential for a reversal upward. Hanging Man. Appears during an uptrend and indicates a potential reversal to the downside. The long lower wick shows an attempt by sellers to gain control, hinting at weakening bullish momentum. To get the most from these patterns, traders often wait for confirmation, a candle closing in the expected direction following the hammer or hanging man. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.